Hello, everybody. Welcome to the Trading with Ashley show. We are having a windy day today, so bear with me. But we are going to talk about the Mag 7 stocks today. And I want you to stay to the end because I'm going to show you a way to get exposure to the Mag 7 stocks with one particular ETF. But let's talk for a brief bit about the Mag 7. For years, investors were told that if you get into the Mag 7, which by the way comprises 30% of the total market cap of the S&P 500, if you get into these 7 companies and you're a responsible investor and you will see over time your portfolio grow. Well, that has been the case, especially the last 2 years. Really, these Mag 7 stocks have been responsible for the vast majority of gains that we have seen in the last 2 years. But now that they are having a very bad moment in time, it's pulling everything down. In the last few years, you have not had an opportunity to get your hands on these stocks with this low of a PE ratio. And this is at a time that they're all investing significantly in AI, which will make their businesses more efficient. So what gives? Why are they being pulled down so much? Well, I have a theory, and there's a couple of reasons I think they are pulling down. One has to do with trade discipline, whether you're institution or retail trader. Think about how you look at your portfolio. When things are rough and red, you sort all of your positions from top to bottom. Well, if you got into these stocks a few years ago, it was the only green that you're seeing in your entire portfolio. Like a good, responsible trader, you are more than likely taking profit on anything that you see as green because we all know building up cash is very important when the stock market is pulling back. You want to have cash to deploy when things are ready to turn back around. But in my opinion, the other reason has to do with the influx of retail traders that we have seen in this space since COVID. A lot of retail traders got into the market when COVID hit and we had the COVID meltdown. And that made sense, right? Because they were seeing the stock market at the lowest levels that they had seen in their lifetime. And what stocks do they pile into? They pile into the Mag 7 stocks. Well, if things were going well, then unfortunately, a lot of them will more than likely use margin to increase their exposure. And of course, they thought they were doing it responsibly because, after all, it's the Mag 7. But when things pull back like they have now, what happens? Those of you that have had too much margin, you know it equals a margin call. And when a margin call happens, if you as the trader don't take control of your portfolio and add more funds to it, then whoever the broker is, and you agree to this when you sign up for margin, they start selling off positions. Unfortunately, the Mag 7 or some of the main positions that they start selling because those are the ones at the top. I want to take you through a few facts about the Mag 7, and then I'm going to get into some potential plays and ways you can profit from the Mag 7 going down. 6 of these magnificent 7 stocks, NVIDIA, Tesla, Google, Amazon, Meta, and Microsoft, they were all underperforming the S&P 500, roughly about a 1% decline. This marked a continuation of a trend we have been seeing throughout 2025. After 2 years of leading stocks rallies, the market's largest technology companies are now leading the major indexes lower. With just 2 weeks left in this quarter, the Magnificent 7 are tracking for their worst performance against the S&P 500 since the fourth quarter of 2022. And you can see that right here. Almost half of the S&P 500's drawdown that we've seen this year can be credited to the decline seen in the 7 market leaders. A stark contrast from 2024 when more than half of the market's gains were attributed to these same stocks. And you can see with it weighting 30% of the S&P 500, that's putting a lot of pressure on the other 69% of stocks, the other 493 companies. Now, even though we know these are great prices to get all of these stocks at, maybe you want another measure of safety because we don't know if we're getting another leg down or not. So I'm going to show you a way that you can trade these and get even better pricing. I'm just going to take one of these Amazon because really they all look very similar. And I'm going to show you a way to get into the game but make your trade safer. This is what we have been doing in my community. So Amazon is currently trading at 192, which is quite a ways down from where it was trading. Also, it's worth noting it is under the 200-day moving average. And most of these stocks are under their 200-day moving average. And the RSI is 32. Anytime we're close to 30, it's screaming, I'm oversold. So you may want to take some chances on these stocks, but you don't want to buy it at 190 and then it dropped down to 175 and you're still holding it. So this is the solution. We are going to sell puts, but we're going to go further out in time and down in strike to make these trades safer. Now, when you sell a put, you have a variety of expiration dates at your disposal. You could go 1 week out, which would be 3/28. And if you were going to do that to get a good size premium, you'd probably want to get a little bit closer to the money. So if we were going to sell the put for expiring in a few days from now, and you wanted to get the maximum amount of premium, you would go ahead and sell it right here at the money, or maybe right below the money, right here at 190. For this put, you would get $345. But again, if that's too risky for you, because if you think we have more downturn in front of us, then we'd like to go down closer to maybe about 175. But as you can see here, if you went down to 175, you're only going to get $55 for 17,500 being held for the trade. That's not the best risk to reward dynamic. So let's go much further out in time. If we like 175 and we feel like that's a safer spot, we're going to go further out so that we can get more premium. Then when things normalize, we'll buy it back much sooner than the expiration date. I'm going to go ahead and take this to December just to give me some time over the next few months if things start to rally. And I am going to go down to that 175 strike. Now, instead of $55, because that was a very short-term trade, we're going to get almost $1,200 for this trade. Now, I know that sounds wonderful, but you're thinking, okay, I've got to leave that 17,500 tied up for the remainder of the year. Not necessarily. You see this delta right here? As the stock price continues to rise, let's say we go through a V-shaped recovery, for every dollar that goes up, this 1180 goes down by 27 cents, or if you multiply it by 100, by $27. So with that being said, if we're to just go back up to the middle of its Bollinger Band, let's do the calculation and see what this would become. If you look at the middle of the Bollinger Band for Amazon, it's right here at about 205. So if your plans were to cash this in once this stock got moving again, if Amazon got back to the middle of its Bollinger Band, and that's realistic if we start moving back up quick, then it would be at around 205. Well, as you can see from this option calculator, if we are able to hold on to $500 of that premium we just received, and we would buy it back, giving up the rest, well, that would be fine because that's going to release all the capital being held, and we won't have to hold this trade to the end of the year to enjoy that kind of a recovery. So the way that you would figure out the annualized return, you would take the $500 that you're keeping and you would divide it by 17,500 because that's the amount of money it took to generate that $500. If you look at that, that gives you a 2.8% return. But you made that quick of a return in just about 3 to 4 weeks. So if you annualize that, that's going to give you about a 33% return. And so I share all this with you so that you're not afraid to push a trade further out in time if it can keep you safer and still give you substantial premium. A lot of times you can get out of these trades early. In worst case scenario, if you can't get out of the trade early, well, at least you're getting assigned at a much lower price, or you're able to roll the trade further out if need be. Now, if all that seems too complicated or overwhelming for you, I am going to introduce you to an ETF. All you need to do is buy this one ETF, and this will give you the exposure to all 7 companies. And when they decide to turn around, when this market turns around, you'll see your portfolio going green again. That ETF is none other than MAGS, MAGS. Right now, it's trading for around $46 a share. And you can see when you put them all together, it's oversold, obviously. So this would be one that you might want to start dollar cost averaging in or establish some of your position now. And then if we have one more leg down, then buy a little bit deeper. That way, when everything starts going back up, this will go back up as well. And then you don't have to keep up with all the individual stocks. Now, some of you may ask about selling options on this. You can, but it is a newer instrument, so the option chain hasn't been fleshed out very much, so it might be hard to actually get really good pricing on your options. You might have to wait a little bit later for that to come to fruition. But if you want to take a look at what this looks like, let's assume that you believe that all of our Magnificent Seven stocks will be riding higher by the end of the year. Then you could, with confidence, go to the option chain that's the longest one on the chain right now. That's going to be in September. And then you could go ahead and sell either right here at the money or slightly below the money. If you sell this $45 put, you would receive $360 and you'd only be having to put up $4,500 to be able to make this trade. I hope you found that helpful and that gave you some insight. Remember, if you are watching me and you get a strange message from me, please do not respond to that. That is not me. You will not hear from me unless you reach out to me personally, and then one of my salespeople will contact you and set up an appointment for you to have a phone call with us. Now, if these markets have you nervous and you want to know how to effectively use puts to hedge your portfolio, I've got the video for you. You can watch that right here.